Hi, Dan Kurz, DK Analytics. Thanks for tuning in. It is September 29th, 2017. I've got a little issue here with my video recorder, and we're delighted you're on board. We have been absent from the scene for a while. A lot of it, frankly, has to do with this month being dominated, the month of September, by Hurricane Irma. Speaking of which, let me run through some things, starting with this terrific storm, which laid a lot of the Caribbean to waste and continued up to the Floridian Peninsula and really pasted the Keys and Naples, which is just to the south of our location here in Bonita Springs, Florida. That is DK Analytics location. Specifically, let me go through some things, and hopefully this will help frame things big and small and at the allocation level as usual, so that maybe it was worth your consideration. People in Lee and Collier County lost power on Sunday. That is Sunday, September 10th. We lost power here in Bonita Springs, the western part of Bonita Springs, for 2.5 days. There are people in Lee County and Collier County, which typifies Southwest Florida, or what consists of Southwest Florida, as is commonly known. Perhaps you can add a county or two to the north to it, but for the sake of this little talk, Collier and Lee County are the mainstays of Southwest Florida, and they have people that have been without, or there have been people without power for 2 weeks. I know of 4 families. And I know of substantial flooding in Lee County and even in Naples, that is in a corner of Collier County. How does that dovetail with what's going on otherwise? I mentioned at the outset that, the month has been defined by Hurricane Irma. I'm talking about prepping for this storm. I'm talking about putting up boards, raising vehicles as high as possible for the threatened storm surge, which I'll get to, and helping neighbors and friends and family out of trouble after the storm, where there were tons of downed trees. No power means, and again, some people just got power back a few days ago. They were without power in some instances for 14 plus days. Now, you might find that hard to imagine, but consider no heating or air conditioning, HVAC. Consider traffic lights which don't work, and the potential mayhem on the streets. Thankfully, people during the 5 days that I saw it in large sections of Lee County were very civil about it, and that's important when you have roads that have 50, 55 mile per hour speed limits where people do 60 or 70. You also have no banks open, you have no gas stations open, you can't pump gas without electricity. Grocery stores are closed. Hospitals are even in trouble as they have priority electricity availability, but the whole economy, including construction and manufacturing, effectively shuts down. And it is very tough for those in this situation. Why do I mention this? Not to toot my own horn here about the lingering preparations and now trying to dig back out of the damage done. Thankfully, we weren't flooded, but others were. But there's trees lying, big trees all over the place that are being cut that have obviously impacted power, electricity deliverability. And what that means is that people, without this power, economic output just crashes. And so does potential societal collapse or mayhem. And what is amazing is that we are pursuing policies thanks to green crony capitalism, thanks to the UN, thanks to socialist leftists which in essence want to dictate or or decrease the standard of living of the average person, i.e. the energy consumption. We are following policies which, like the German Energiewende, threaten huge brownouts, blackouts, reduced productivity, reduced standards of living, increasing poverty, and again, societal dislocations and potentially even mayhem, especially given the huge global population base. And the storm here in southwest Florida and in the Caribbean is but a microcosm. Puerto Rico has been laid to waste. I mean, I've been there. It's a beautiful mountainous island, but the majority of the 3-odd million people living there don't have power and won't have power. And my message is, if we carry forward the green cronyism that is shutting down power plants, coal-based power plants left and right, and trying to push us into idiotic so-called sustainable energy policies, which we talk about at considerable length in post number 21, which aren't 24/7, aren't affordable, can't be stored, are just a nightmare. In other words, you can't run a modern leveraged output economy on them. If we continue down this path, we're going to see Irma writ large on a national and global level. And what else is worthy of mention here as regards Irma? The following. We had, in the days leading up to September 10th, say the 5-6 days before, as Irma started to gain strength and became a Category 5 hurricane, the strongest hurricane category of all. As it blasted west and slightly north, the NOAA, the national weather forecasters, and all their ilk not only totally got the storm's trajectory when it turned north wrong, I mean totally wrong. They initially said east of Miami, and 2 days before the storm actually landed, they said, oops, it's going to continue to the west coast of Florida, southwest Florida, or possibly head out into the Gulf. And I'll tell you what else they got wrong. And I'm talking people that called me from Annapolis, from upstate New York, the weather forecasts I saw locally over the internet, the neighbors, but we here in southwest Florida were threatened with by every major weatherman of any name and fortune with 10 to 20 foot high storm surges. Now that's biblical flooding, ladies and gentlemen, biblical flooding. What happened? We got between 3 and 6 inches. What's my bigger point here? With knuckleheads like this, that cannot even, with any degree of accuracy, predict the trajectory of a major storm, a Category 5 hurricane, the worst there is, either in terms of where it's headed or, very importantly, in terms of storm surge impact. The most severe impact from hurricanes are usually flooding related, almost always. The structure's pretty vibrant, with few exceptions, but if you're flooded, you can bulldoze your house, right? But with weathermen using high-zoot computer models, unable to even get anything clearly right other than there's a Category 5 hurricane heading west and at some point will go north, how in the hell can any of these clowns come out and tell us what the globe's climate is going to be 5, 10, much less 20 years from now? It's an utter disgusting fraud, and sadly it has taken out a lot of spare capacity and vibrancy of our electrical grid, not to mention affordability, and it's only going to get worse. So Irma is a story that could be writ large if we sustain the current green energy policy. Thankfully, Trump got the heck out of the Paris Accord. Let me shift to Trump's tax plan, speaking of the Donald, of the Trumpster. I'd say it's a plan. It's hatched by Wall Street, by K Street, by the very swamp monsters have their paws all over it. It is not tax simplification. It is not tax reform, much like Obamacare reform hasn't been reform. And what is to be said about this is, sure, there are positive aspects. For example, reducing the corporate rate from 35 to 20%, reducing the 3 individual tax brackets pretty smartly, also increasing the incentives for American corporations to repatriate capital back home. That is, if they believe a lower tax rate environment has any legs to it. And in that regard, here we go with Donald Trump and his Democratic roots and his crony roots and his the art of the deal nonsense. He's cutting a deal, dangling a carrot to leading Democrats like Chuck Schumer and Nancy Pelosi that he would be open to enacting at some point a 4th income tax bracket. Now, the problem here is that that is obviously going to be taken advantage of when the Democrats return to power. It's not a question of if, only when. And then you know where we're going. The government as a percent of GDP is just going to grow and grow. And the incentives for free market vibrancy will continue to head south. Now, staying on topic, something also worthy of mention here. The decline in the tax rates that Trump suggests or is trying to implement have, like many of the other things that Donald Trump says, they have a huge credibility problem. Trump is the consummate hypocrite on too many fronts. Consider, if you would, while he was running as a candidate for the president, he talked about the totally fake unemployment rate. It's not 5 or 6% at that time, it's north of 20%. And he talked about the stock market bubble. Well, now he takes credit for a slightly lower unemployment rate thanks to people migrating to 2-3 jobs instead of 1 full-time job, and the ridiculous birth-death models of companies, which is dead against the reality of real net corporate new formations. And what this man has said about the bubble is true, only more so. Yet now he's taking credit. So with that as a backdrop, caveat emptor in terms of trusting this guy, and we've seen it in Obamacare, we've seen it with building the wall, he is not solid. He's a deal maker, and he has Democratic/crony business dealing roots. And those habits are proving damn hard to shed in too many instances. But if we look at the tax reform cobbled together by Goldman Sachs people, the very swamp monsters he derided when he was running that dominate his cabinet, together surely with the tax consultants sitting on K Street, what we have is a huge political fudge. We have, in fact, a plan where the decreases in the individual tax rates is not only open to a 4th new one, but we have a sly feature of this. Again, it's a politically based, crony-based piece of legislation, not a tax reform, not a tax simplification. The fact of the matter is that roughly 80% of America's, the federal government's rather, not America's, the federal government's tax receipts come from individual tax payments, one including withholding or FICA taxes, all right? And only about 10% come from corporate. But when we look at that 80% that come de facto from individuals, including, again, withholding taxes, Social Security, Medicare, and all that stuff, what we see is that roughly 17% of taxpayers pay roughly 80% of all taxes collected from individuals, which in turn, again, constitute roughly 80% of all government revenues. Now, with the Trumpsters tax plan here, what we have is the following. we have a spoofed up, a turbocharged sub-S and LLC provision that would allow highly paid accountants, tax attorneys, entertainers, consultants, so on and so forth, that have an employee status to shift from being an employee to a proprietor or an arm's length person. What's the word I'm looking for here? Hold on a second. Contractor, that's the word I'm looking for. If they become contractors and in essence set up LLC or subchapter S entities instead of staying on the payroll, their taxes, and these are the people, remember, top 16% of all returns pay 80% of all U.S. taxes collected or contribute. The top 3 or 4% contribute something like 51% of all U.S. tax revenues. So what you're going to see is thanks to the hodgepodge, the political / K Street / Wall Street based tax redesign or complication, will allow these people that earn the big bucks to reduce their corporate or their marginal tax rate from 33% to 25%. These are the very folks that generate roughly 50%, or these kind of folks, and including athletes and entertainers in that. I think I mentioned entertainers. But these are the kind of folks that pay the vast majority of income taxes, combined, that is, as a group with the other 14% or 13%. So here we go. We have potentially huge loss in tax revenue. Thanks to this, we have more people that are going to get taken out of paying any federal taxes. And at the same time, we have access to federal assistance, to transfer payments, to welfare that is growing, not decreasing. We have over 71% of the federal government's expenditures, which continue to grow. No departments have been cut. No personnel at the deep state or the administrative / regulatory agencies. They're still all there. And as a result, they're a bulwark against real reform and reduction in government outlays, because you can't shrink the very agencies responsible for their bailiwicks. And they won't let go. That's clear. So if we consider the fact that we have 71%, including interest rate payments of the federal yearly outlays, are in fact untouchable and are increasing. And at the same time, we're going to potentially axe tax receipts. Why then, guess what? We could end up with ballooning deficits before any of the infrastructure stuff is done, and before we get an economic recession, which will only increase social transfer payments by the government. But all this could end up backfiring. Why? Because we have a heavily indebted / interest rate sensitive national and global economy. The U.S. economy, if you add federal debt, you add state and local debt, you add individual debt, and you add corporate debt, you're talking about debt of roughly $48 trillion. Meaning, and don't forget, we have artificially low interest rates thanks to central bank puts, threats to purchase bonds, actual purchasing of bonds, artificially high bond prices, government agency bonds, and as a result, the rest of the bonds, corporate and the like. That could change at a moment's notice, because we're in a bond bubble, meaning anyone that buys in virtually any bond, and most of them have junk bond credit characteristics, yet are yielding as if we have nirvana on our hands, wealth of nations, productivity-based nirvana, when we have just the opposite. Those bonds where the bond vigilantes could run for the hills, and we could have substantially higher bond yields. That is, the cost of carrying, just at the national level, $48 trillion in debt, again, federal, state, local, individual, and corporate, the non-financial corporate type, would go up by nearly $500 billion if the average annual cost of servicing debt would go up by only 1%. And again, we're way below any semblance of long-term average rates. And despite what you hear from many analysts, we don't have reversion to the mean. The markets aren't a mean reverting mechanism. They are reversion beyond the mean, from boom to bust in this case. All right. In other words, we're not going to go to treasury yields of 4 or 4.5%. We're going to go to 6 or 7 when the wheels come off the bus. So what I'm trying to say is this fiscal insanity was propagated by Trump, where he's ready to take a meat cleaver to some tax revenue or tax proceeds on the one hand, and incentivizing people to not necessarily produce more or be Reagan-esque in that you just have a simple move towards a flat tax without all the shenanigans and all the loopholes which make accountants money and make them busy, and tax attorneys, instead of really freeing up capital for productive to build better widgets with. We could have the worst of all worlds. We could have galloping deficits, weak economic growth, and higher interest rates. And when you're such an interest-sensitive economy as the U.S. with $48 trillion, the globe is up to over $315 trillion. Caveat emptor, look out what you wish for. The tax stimulus could be overwhelmed by bond vigilantes saying, no, this is too much, we're going to run for the hills. So whatever the stimulus is from the tax side, it could easily be overwhelmed, is our point, with substantially higher debt servicing costs. What else do I want to address? The U.S. economy. Whatever you hear and read, the U.S. economy remains sluggish. Let's cut to the chase. If we take a look at durable goods orders just recently released, they're still over 9% below the pre-recession high. And so is manufacturing output as a whole. And even though manufacturing is only about 20% of GDP, it's the high value-added part of it. And if that isn't growing, then demand for the services isn't there either, right? We have manufacturing sector continuing to bleed jobs down to about 12 million from 20 million at the turn of the century. We have new and existing home sales 60% and 26% below their pre-recession highs, respectively. We have real family disposable income under substantial pressure as a result of a move from full-time, higher-paying jobs with benefits to part-time, as a result of the corrosive impact of inflation, which has long been higher than the statistical phonies that the government stated is after all the revisions. And we have the huge negative redistributionist aspect of Obamacare, which is killing middle-class families working hard with mortgage payments that are suddenly are overshadowed by, you guessed it, healthcare payments, not to speak of higher deductibles and copays. So the U.S. economy is still running on borrowed time, and we don't have a wealth of nations trajectory back, which respects liberty, property rights, and gets us back to regulatory and tax sanity. It's more of a political hodgepodge, right? Finally, as regards the Fed and the dollar and to allocations and before allocations evaluations, consider, if you would, the following. We have clueless central planner Yellen. She has left herself and her pals at the Federal Reserve so much wiggle room to either raise or lower rates. This mealy-mouthed, well, if this doesn't work, we'll try that. They have left themselves plenty of wiggle room to both raise and lower interest rates, to backtrack from any semblance of quantitative tightening back to quantitative easing. And in reality, they're bluffing because they know the economy is got a tremendously weak pulse that's getting weaker. The world continues, at least at the margin, to de-dollarize. Witness the recent announcement from China that it's setting up a yuan/gold-backed oil trading scheme or system, which is going to do a big fat circle around the dollar. Consider the fact that Venezuela has joined Iran in not accepting dollars for oil deliveries. Consider the fact that large emerging or re-emerging nations are dealing amongst themselves in their own currency terms. Consider that European nations such as the UK and Germany have signed on board trade agreements with emerging markets that circumvent the dollar. Consider all that at the margin, it can become corrosive over time, and there's a tipping point. If that tipping point is reached, the dollar is really going to head south, especially given the excess of dollars held overseas if there is less need to use them to trade oil and other things with, obviously. So what's the impact? Potentially much higher inflation in the United States. That in turn would at some point negatively impact bonds. You get into a vicious cycle of then bond vigilantes selling as they whiff the smell of higher inflation. That raises the discount rate for stock markets, and that ultimately, together with a weakening economy, is going to really be a powerful 1-2 punch for valuations, both in this case in stocks, but triggered by a higher discount rate and accompanied by weaker bottom line numbers. Speaking of which, bottom line, EPS has been leveraged by massive amounts of stock buybacks. That's why corporations have some $6 trillion in debt. The government leads with $20.2 trillion, which all of a sudden, went way up. Funny how within a month it goes up by about $1 trillion, isn't it? It's some sleight of hand going on there. But you got the federal government, $20.2 trillion. You've got state and locals at about $3.3 trillion. You've got individual debt, including mortgage and credit lines for student loans and car loans and what have you, up at about $18 trillion. And when you wrap it all up, you get to this $48 trillion or darn near nut. So you have to be very careful, given the interest sensitivity of the economy, not to reach the tipping point of killing whatever momentum there is left. But juxtapose that against the potential de-dollarization and the negative impact that this would create upon perceptions of bondholders and increasing U.S. inflation risk as those dollars come home, and we really have the phenomenon of too many dollars chasing too few goods and services come home to roost. If that wasn't exciting enough, Catalonia wants to leave Spain. The Kurds want to leave Iraq, understandably so. We've got North Korea wanting to nuke America. America is increasingly balkanized between the constitutionalist conservative heartland and the increasingly leftist coasts. And talk about geopolitical instability. Yet, most stock and bond markets remain at bubble valuations, meaning untethered from any hope of realistic returns, much less protection of capital or purchasing power. Thus, the ultimate reallocation broken record by yours truly on behalf of DK Analytics. It's not a question of if, it's only a question of when, before traditional assets, stocks and bonds are valued at much more attractive levels in terms of return potential. We're talking bond yields that don't revert to the mean but go way beyond the mean, from 2 to 6. We're talking or 7 or 8, you tell me. We're talking about PEs that go from the mid-20s to potentially sub-10 PE or into single-digit terms. Those are the kind of opportunities people that have the intestinal fortitude to step away from the crowd and revisit reality and economics 101 and financial analysis 202, to go back and get into safe cash outside of the banking system, UST bills, notes if you can to a certain degree, and also to embrace scarcity assets. Oil, dense energy, and food are always do well because they can't be printed and they are scarce, and they will get scarcer. And also consider those shiny metals, but in physical form outside of the banking system. And if you do these things, you might underperform, and you have underperformed, as our Q3 performance numbers will show, but you could position yourself with retained capital, or possibly even turbocharged capital, if you purchase enough of the shiny metals, to have a field day at the sales event that we're going to have when global bond and stock markets go from overvaluation to undervaluation to reversion beyond the mean. And as we're going from boom, we're going to go to bust. And you can avail yourself with potentially intact capital if you get out of overvalued bonds and stocks to a significant enough degree, and potentially even increased capital or purchasing power if enough shiny metals reside in your portfolio as a percent of the holdings. We suggest 10% or more. And this is, again, a strategic and at some point a tactical opportunity, perhaps of a lifetime. Hope that makes sense. Thanks for listening. Over and out.